Hey guys, welcome back to another episode of the Making Banks Personal. Wait, what did you say, Benjamin? The interest rates are blowing through the roof right now? Let's talk about it in today's episode. First, let's quickly go over what is an interest rate. An interest rate is the percentage that a lender charges a borrower for borrowing the money. Now you may be wondering, why are interest rates so high right now? To answer that question, we need to dive a little deeper. The answer is inflation. Inflation right now is at an all-time high of the last 40 years. It's because people are spending too much to get highly demanded goods, and there is just simply not enough supply of these goods. Inflation is essentially the general increase in the prices of goods and services. This is unfavorable to society as prices of goods and services are increasing at a higher rate than wages are increasing. This leads to a decrease in the standard of living. To combat this, the Federal Reserve will increase the interest rate in order to slow down the economy and the demand of goods and services. Higher interest rates will make it cost more to borrow money, therefore less people will borrow money, which means people will spend less. Less people buying goods and services will force businesses to bring their price back down as the demand decreases. You may think that this solves the problem, and you will be right, but it doesn't do much for the second problem. This will incentivize people to put money in the bank and essentially do nothing with the money, since the savings rate will probably also be increasing, since the interest rates are increasing as well. By increasing the interest rate, you are essentially decreasing the demand in the overall market. Businesses aren't able to borrow money as cheaply, and investments are going to be slow. Consumers aren't going to spend as much, and the economy is not going to be as fast as it used to be. But of course, right now inflation is a bigger problem than growth. So the Fed thinks they have to increase the interest rate. On the bright side, this process usually takes around a year for the widespread impact to occur on businesses and consumers. Unfortunately though, the stock market will be affected right away, and it will be hit hard. The economy runs separately from the stock market, so when the interest rate rises, the market will be affected immediately, which is what we're seeing today. Businesses on the stock market are valued by discounting their future projected earnings to the present value. The discounted rate for the company's future earnings is called the WACC. This is what you expect to get as a return given the risk that you put in. The cost of debt is basically the interest rate on the debt. If the Fed increases the interest rates, it's going to cost more money for the company to borrow money, so their cost of debt is going to rise. A higher cost of debt means a higher discount rate. As for the cost of equity, this is made of the risk-free rate, the market risk premium, and the beta of the stock. The risk-free rate is more important here. The risk-free rate is basically what is the minimum return you can make with zero risk. For example, these are your government bonds. The US government hasn't and most likely will never default. Therefore, it will always pay its interest payments on time. If you invest in the 10-year government bonds, you won't lose money, so therefore it will be quote-unquote risk-free. Since interest rates have risen, then the returns you get from the bonds are going to be higher. Higher returns from risk-free bonds means a higher risk-free rate. And as you can see from the equation, a higher risk-free rate means a higher discount rate. All of these topics are pretty technical, so if you want to learn more about these topics, please check out our WACC video that we're going to make in the future. But the point is, a higher cost of debt and a higher risk-free rate will result in a higher discount rate. A higher discount rate means the future earnings of a company is going to be worth very little in the present moment, which will completely drop the stock valuation. Lower valuations will cause investors to pull out of the market and sell their stocks. Instead, people will be incentivized to invest in risk-free assets such as bonds, because there's simply not a good reason to take a lot of risks on stocks when you could make a perfectly good return on low-risk assets such as bonds. However, this is just a theoretical situation. In real life, there are going to be much more aspects that drive the market. Now, let's look at the real stock market. Looking back at around 1993, every time the Fed started to raise interest rates, the market had a period of volatility, which are the circled areas on the graph. However, after around 2 months, the market starts going back again, even though the Fed is still raising the interest rates. This means in practical situations, it's only the rumor of the interest rate hikes that make the market go down, not the actual rising of the interest rates. Of course, it's important to keep in mind that this is a small sample size. In these types of situations, people often freak out in the beginning and then forget about it a couple months later. One reason for that could be because of earnings. The Feds will only raise the interest rates in the periods of fast economic growth, as doing it during a recession will completely cripple the economy. During periods of growth, earnings are high. Fast earning growth could offset the impact of interest rate in the discount rate, and this can cause investors to buy again. So let's take a step back. In reality, we don't actually know what's going on right now. It could simply just be a repeat of the historical behavior. The worries about interest rates will pass and the market will rebound. However, our advice is if you believe this time because of the 40-year high inflation issues, geopolitical issues, and rising interest rate is going to make the market drop even more, then get out or short the market. However, I will strongly caution against shorting if you do not know what you are doing. Hope you guys enjoyed this video. If you did and learned something, be sure to click that like button and smash that subscribe button. Join the Making Banks crew for more financial videos just like this every single week. This is your host Richard, and I will see you guys in the next one.